the stock attempt to shake off recent weakness. Hello, my name is Marcus Koo, and this is our Market Weekly Wrap-Up. On Monday, the S&P 500 settled higher by 0.5% despite enduring some intraday weakness, while the Dow added 0.1% and the tech-heavy Nasdaq gained 0.9%. Technology stocks led from the start, with Microsoft providing considerable support after ValueAct announced a $2 billion stake in the software company. Other tech shares also displayed strength as Apple climbs 2.1%, although most large tech names ended with gains. IBM shed 1.1% to follow Friday's earnings-driven 8.3% drop. Tuesday's session ended with strong gains as the S&P 500 ended with 1% gain. Financials and technology led the advance, with bank stocks outperforming notably. The SPDR Financial Select Sector ETF settled higher by 1.8% after Discover Financial Services and Dow Component Travelers reported better than expected earnings. The major averages ended Wednesday's session on a mixed note as the Dow shed 0.3%, while Nasdaq and S&P 500 ended flat. Consumer staples lagged after Procter & Gamble reported revenue below the Capital IQ consensus estimate. In addition, the company issued cautious fourth quarter earnings and revenue guidance. The top performing sector of the year, healthcare, declined steadily throughout the day after Amgen, Edwards Lifesciences, and Eli Lilly all reported below consensus revenue. With modest gains, the S&P 500 climbed 0.4% as materials outperformed throughout the session. Miners were among the top sector components as precious metals rallied. Gold futures advanced 2.8% to $1,462.80 per troy ounce, while silver futures spiked 6.2% to $24.25 per troy ounce. Also of note, copper rose 2.8% to $3.247 per pound. The major averages entered the weekend on a mixed note as the S&P 500 slipped 0.2%, while the Dow Jones Industrial Average added 0.1%. The final session of the week began on a cautious note as downbeat overseas trade and mixed corporate earnings pressure equity futures. In addition, a disappointing first quarter GDP report contributed to the lower open. According to the advanced report, first quarter GDP grew at an annualized rate of 2.5%. That was up from a 0.4% gain in the final quarter of last year. A deeper look into the data sets the tone for a likely severe deceleration in trends during the second quarter. The S&P 500 index finished last week 1.7% and gained in 4 of the 5 sessions. The Dow Jones Industrial eked out 1% gain for the week and underperformed the other major market indices. The tech-heavy Nasdaq rose over 2% for the week as the sector is trying to make the up ground. Friday's first quarter GDP came in at 2.5%, which was lower than forecast by about 0.5%. In the long run, this number may not be matter as the Fed continues to provide liquidity in the form of $85 billion a month in asset purchases. Earnings season was in full swing this past week as 34% of the S&P 500 reported quarterly results, and about 70% of companies are beating earnings per share figures, but more than half continue to miss revenue estimates. This common theme has many companies pulling back on guidance for the year also. Companies are lowering expenses and investment to produce higher returns for shareholders, but this can negatively affect growth. Commodities rose this past week as investors bought into recent weakness. Gold futures gained almost half of their massive losses from a week ago as investors are trying to pick a bottom in the precious metal. Oil futures rose 5% for the week as investors bought commodities across the board. The price of gas quickly followed suit higher, which will not help consumer purchasing power. The busy summer driving season is upon us, so many are predicting $5 a gallon gas in the near future. This will most likely cause pain for the domestic economy as the almighty consumer will cut back on discretionary spending. The Chicago Board Option Exchange Volatility Index broke through $14 on the downside again and finished the week off 9%. The fear gauge has traded in a relatively tight range over the past few months as stocks have consolidated. Option premium fell as demand for protection decreased throughout the week. Market volumes remain tepid as stocks chop back and forth in a tight range. Treasuries also rallied despite the strength in stocks. Historically, you see these products trade inversely, but demand for bonds remain robust in spite of high prices. Many analysts are calling in the top in US Treasuries, but the bubble has not shown any signs of bursting. The 10-year yield is down to 1.66% and is at the lowest level since mid-December. The question remains is it the domestic money manager buying bonds and overseas institutions and government propping up the prices? Eventually, either treasuries or stocks will break their trend and the downturn could be shifted. The week ahead is full of potential market-moving events. Heavy doses of earnings continue this week with major reports from the pharmaceutical and insurance sectors. Lackluster economic data recently puts more emphasis on this week's numbers. The Chicago PMI and Consumer Confidence Index for April are due on Tuesday, and the Institute for Supply Management's manufacturing data will be released on Wednesday. Also on Wednesday, the Federal Open Market Committee will announce its monetary policy decision, and on Thursday, the European Central Bank's Governing Council meets and issues a policy decision. Round out this week, Friday will see the release of the April report on non-farm payrolls and the ISM Services gauge, along with March factory order. The FOMC and ECB meetings will be important. The markets are expecting some form of easing from the ECB's Draghi, and stocks will most likely come under pressure. Nothing. The psychological headwinds next month also come into play for investors. The sell in May and go away theme has played out the last 3 years as stocks have fallen sharply during the month. And that concludes our Market Weekly Wrap Up, and I'm Marcus Koo. See you next week. Bye for now.